So we had a rocket launch in North Korea today, apparently, but there was an even bigger rocket launch that occurred in the U.S. stock market with a big move today that results in a pattern that we may have seen before. So I'm going to break down this pattern and see if today's move combined with a couple other bigger moves that we've had here recently, what does that mean, and does that change anything about this bullish expectation that we have typically for the month of December from a seasonality perspective? And is there a way to take a trade idea where I can limit any risk to big upward moves like this and take advantage of a pullback? Let's go ahead and get started. Today is Tuesday, November the 28th, 2017. My name is David Settle. This is my market outlook for today. Thank you very much for watching today. Welcome to those that are watching for the first time. Keep coming back for more. Subscribe to my YouTube channel by hitting that red subscribe button down below the video. Hit the thumbs up next to that. Let me know that you found the video useful by clicking with one click. Very easy way to give me feedback. Scroll further down, comment on today's video and anything that stood out to you. I appreciate your comments there. You'll see in the description there's a link to join an email newsletter for the market outlook that I send out every day. Follow me on Twitter. You'll see my Twitter handle on the screen at DavidSettle42 for more content that I put out there throughout the day. You'll see my tweet for today's market outlook pinned to the top of my timeline. Like it and retweet it if you think other people should check it out. And of course, you can also join the Market Outlook community on Facebook. You'll see the address there listed on the screen as well. You'll see a link to that group also in the description of the YouTube channel, as well as a link to today's Market Outlook tweet and Facebook post on my Facebook page. All right, let's take a look at the S&P 500 first off with the market forecast indicator. Quite the day today, as we mentioned, strong bullish posture remaining. So the intermediate line still in the reversal zone, so still showing still classified as a strong bullish trend. It's kind of hard not to classify it, especially after a day like today. But even before today, still classified as much potential red flags or maybe weakness or anything that may be out there that can limit it. Doesn't take away from the fact that it's still in a strong bullish posture. So days like today, of course, today wouldn't have happened without this idea that the tax reform passing the committee, good odds. I mean, even the missile launch from Korea didn't derail what happened today. But if the market was expecting what happened today to occur, we would have already been close to this level. So it was still kind of a question mark. But a rally like today can occur when you're in a technical environment that we are in right now, which is a strong bullish posture, right? Again, very mature, but still strong nonetheless, and that opens the door for a day like today to happen. Now, again, it only happened because there was a news kind of announcement that came out that the market wasn't fully expecting. Otherwise, they would have already priced it in. And so they got this announcement. They priced it in very quickly throughout the whole day, even with a potential bearish geopolitical event coming out to offset it briefly. I think the Nasdaq even might have gotten a little red briefly after that missile launch announcement, but very briefly, because we bought the dip, came right back in by the end of the day. Not interestingly enough, because of how small these 2 days were, and this isn't just a momentum line, it's not just a one-day deal. It did rise up significantly on today's move, but because of how small these were, in fact, for the last 5 days, were insanely small ranges. That it's like, okay, again. So here, I brought this principle up before. This day was bigger than what you'd expect, so we pulled forward some movement. This day was also a little bit bigger than you expect. It was right before Halloween, right before Thanksgiving, a few days before Thanksgiving. So it pulled forward some movement there because it was bigger range, bigger volume than normal. At least then again, about average, about normal. But when we're in this really bullish phase, we expect smaller ranges, smaller. And so that's what you got these last 2 days. In fact, these 2 ranges were very smaller. So you're pulling forward. So now the question is, how many days forward have we pulled forward? See, another day like this, where we've been bullish for so long, where the posture's been bullish, for a while. For this case, almost 3 months. If you go back to March, you can see, in fact, let's go over here to the beginning of the year. So the posture turned bullish in November. So if you count from this point here where my cursor is, in fact, I don't know if you, there we go, right there. Then you can see from that point here, we had 1, 2, 3 months. So that's kind of where we're at right now. We're at the 3-month mark. We had a very bullish posture here. And then we rallied. And you can see a lot of these days, you know, we kind of peaked with some smaller days here. And then we grind, you know, we were grinding for a while. And then we took off in February. And you can see on that March 1st right there, big range, big volume, close to a cluster, but not quite. Mature bullish posture, because we are now at that point almost 4 months into this intermediate trend. So that started basically right here off that low point. So very mature, kind of a blow. I mean, we had a lot of volume on March 1st. So you can almost consider a blow off top. What happened? 2 months later, we had that. You know, we had an intermediate pullback. You know, not trend changing, not long-term trend changing, but enough to bring, you know, the intermediate line down, to bring the market sentiment line down to a launching point where we started a multi-month slow grinding upward trend, you know, and so it goes. So today you can see again big range, a lot of volume, not as extreme. It was 3 standard deviations back then. This one's not quite that much, but still, you'll see it here in a minute. More than two standard, more than 1.5 times the average volume, and not quite a cluster on here, a bearish cluster, an overbought cluster, excuse me. But you can see very mature. We've been bullish now for 3 months with market sentiment at a really high level here. See, back in March when we had, let's see, note right here. Back in March when we had that one, you can see market sentiment had already peaked almost at 90 and had been dropping. So here, market sentiment peaked above 90 and has been dropping. So are we showing very similar? That was something I posted on Twitter earlier in the day. Oh, this one right here. Or earlier in the day, I posted, are we looking similar to that same setup that we had on March 1st? That now, again, from a seasonality standpoint, and, you know, again, the posture is strongly bullish, market sentiment is strong, so everything's still there. So we can't say, okay, let's short this bad boy. Otherwise, you're going to get run over like a truck. And also, you add in the seasonality. December, typically a bullish month. In fact, I think I tweeted something out about December as well, about how bullish it can be. So there's a lot of factors right now, technical and seasonal, that point to bullishness by the end of the year. But you also have this setup here that says, you know, we might have pulled forward a lot of that bullishness over these 3 days here, 1, 2, and this day. How much of that move have we now pulled forward because we haven't dropped enough and we've moved up faster? I mean, shoot, off of this low point here that we just had, and what was that? November the 14th. So off of that low point, we are now up, what's that say, 2.75%. So in 13 days, 2.75%. As you can see the numbers over to the left. Well, I'm looking at my left, so it would be the left on your screen, I believe. That second number from the left is a percent change. That's 2.72 over 13 days. The second number from the right, 112% annualized return. So very strong move. I just wanted to see if we would have had this, if we would have gotten to this level by the end of December. So see, right about in that area. Look at the annualized return there. The percent return still about 2 point some odd, you know, 7 says. Get right up to, try to get that 2.72 right there. And we have to come over here a little bit, right there. Right about there. So almost a 25% annualized return there. That's a pretty decent move. But we got this move in 13 days instead of it being in 48 days. Big difference, and that's what I'm saying is we might have had that seasonal bullishness already in a matter of 2 weeks. You can see how we continue to be really bullish here from a long-term perspective as well. We are well up above the 50-day moving average, and let me let me just bring up here, and I've got this over here on my other screen, but I'm going to change that MACD down at the bottom. This measures the gap between the 50 and the 200-day moving averages for those that are new to this video. We're going to look at the gap now. There's the gap between the price, current price, and the 50-day moving average. So we are, we're really bullish. We're well up above it. When you get about 50 points up above, we don't stick around very long. In fact, you can see, let me get my pointer here. So here's where we got above it last time. We went up a few more weeks before we stalled. Over here you can see we went sideways for a few. So I'm not looking for bearishness, right? But just this idea that we went up a couple more weeks and then we pulled back to the 50. You can see here we got well up above it and then went sideways for a few weeks. Don't be surprised if we don't get some kind of sideways action again, considering that we may have pulled forward a lot of this price action with today's solid move. Again, you look at it from an 8, from a MACD and stochastics perspective, that possibility of divergences are still there, just barely, but they're still there because we haven't broken up above the new highs yet on this MACD. One thing to also look, if I were to change over here, if I were to change this MACD and look at it from a price perspective compared to the 8-day moving average here, just to see how far up above we are. So there's how far up above we are above the 8-day moving average, 25 points. So we've been this way before. So let me get this out here. So we were 25 points up above the 8-day moving average right there, but we were coming up off a low point there, which typically it can be the case when you're coming up off of an intermediate low. You typically get a big jump, a big strong jump, and then we start to slow down a little bit. Well, there's a big strong jump there. Here's that March 1st. That's the last time we've been this far up above the 8-day exponential moving average. So again, you can see how there's similar patterns here, and you can see as well we were that far up above it earlier than that, a couple weeks before that, and then finally you can see this top where we went sideways for about a good month. We were that far up above. So we are strongly bullish right now across multiple time frames using multiple measures. On the intraday chart here, again, small ranges that busted out here, and of course we're busting well up above that 20-day moving or the 4-week range. So we really need to move this sucker up now. It's going to come all the way up to here, but a big. See, now we're back up to a strong gap, which is good. It's a good thing because as that gap tightens, when it does tighten up, and we've got some time before we'll tighten it up here to this. We have about still less than 10 days before we tighten it up to just under 258. Again, that would just be a 4-point, a little bit more in a 4-point range. So we've got some time for it to kind of grind higher and push that top up a little bit higher. That'd be a very good thing. And again, if you're looking for a sharp pullback anytime soon, they typically don't occur from the tops of a 4-week range. They usually occur after you've broken through the midpoint of the 4-week range, which right now happens to coincide with that area, this 259 area. And you're going to have to break through that before you're going to get anywhere close to a more extended intermediate run. And while we're in the top half, especially when we're pushing the top end, then at the worst, we're going to just kind of grind our way higher. So here you can see the volume, again, not as extreme as it was back here in, let's see, March right there. But when this was included some other data, that was above the 3 standard deviations line. So we're not getting anywhere close to that now, but it is higher volume compared to what we've seen here for a while. And again, we had a high volume here, but this is coming up off of an intermediate low point. Here we have high volume at the end of, well, at least not at the end, but during a more mature bullish posture. So again, last time we've had this much volume in an up day and a mature bullish posture was March 1st. Looking at volatility, you'd think, man, volatility must have really dove. With such a big move today, it must have really just tanked. Nope, volatility didn't tank. In fact, it actually rallied today, finished higher on the day. So think about that for a minute and consider how how much staying power this move might have today in terms of follow through. That doesn't mean we have to tank, but it just means in terms of like continuing this kind of move, it's going to be hard to have that follow. The volatility market not believe and not putting a lot of stock into it on an absolute basis, and then of course on a relative basis, you can see here on this chart, it went up too. So now we're out from below this 80% level, which is kind of that extreme low point. It's rising. So volatility is actually rising on a day when the market took off and potentially kind of a blow off top here. Not as much volume, so I wouldn't completely classify it as a blow off top. One other thing too that does have going kind of against it in terms of too much too fast is the fact that it was a 2.25 point range today. You add on about another 1/4 point from the gap from yesterday's close at 260.25 to today's low point at 260.5, a little bit above a half. So you added on about another 1/4 point, a third of a point. So we're looking at more than 2.5, up to 2 2/3 point range, including the gap, which is extreme. And again, the volume. Where was that volume at? It was right here, 98.5 million there. So you take a look at that volume on its over here, and you can see 98.5 isn't even on the chart. I mean, the high end of the range is 90 million, 97 million over there. So it's off the chart a little bit, just barely, but a little bit. So extreme volume, extreme ranges with rising volatility. Again, we may have had a little bit too much too fast today. Not that I'm calling for us to reverse it all tomorrow, but it's going to be hard for it to have that normal December bullish run that we expect based on seasonality, when all of next month's run may have all occurred in the last 2 weeks. So I just spent a lot of time breaking down the technical picture, and I won't spend as much time on the kind of the fundamental, just to avoid boring you to tears and having the video go too long. Just know that from a calendar perspective, the biggest things that came out today: trade, that the housing price index, you can see as expected 6.2% year over year. When you look at, so that was kind of the big news today. Consumer confidence came out today. This is from the Conference Board, so not the University of Michigan, or excuse me, this is the the University of Michigan survey? No, excuse me, this Conference Board. Sorry. The University of Michigan also comes out at the end of the month. The revision does, but I believe we already had that one. This is the Conference Board's 129.5, and again, we haven't seen this number since for a very, very long time, since the 2000 time frame. So strong numbers, and we see it reflecting in still a persistently high economic surprise index, and it's also reflecting itself combined with the testimony from the new Fed chair nominee, the fact that there's going to be rate hikes, that the market hasn't priced in balance sheet reduction yet. There's a lot of comments from them today, but you can see the market is looking now. It's that second rate hike. The fact that we won't get a rate hike at all in 2018 after the December rate hike is now almost down to 20%. So 80% chance we'll get at least one, and the fact that we could get two is rising. Now, once this line starts to drop and this line starts to rise more, then the March rate hike is going to be baked in the cake like December, and the June, the fact that we could get two is going to start rising. And there you can see here, here's no rate hike by March, the purple line. After December, again, after December, that one's already baked in. The green line is no rate hike in December, and so that's gone. So the purple line is no more after December, and you can see it's now fallen below the red line, which is 1. So it's getting more and more likely we'll get 1 by March, and then you can see the June chart saying it's getting more and more likely we'll get a second one in June. And again, the press conferences are scheduled typically in those months too. So that's the Fed likes to make those kind of decisions when there's a press conference and they can talk about it. At least that's the current regime's strategy. Before, it was like every meeting they would raise something. Back to last time they had this rate hike cycle. This one, they've been a little bit more. They've been doing it quarterly, and again, it has to do with that more transparency. With the press conferences that they have scheduled now that they didn't used to do on the last rate hike cycle that they had in the middle part of the last decade. So you can see tax reform impacts small caps more than anything, and they rallied the most today and finished at the highs of the day, strongly higher today, the highs of the past 2 weeks. But U.S. stocks outpacing because, again, they're going to be the biggest beneficiaries. But risk appetite was on for everything except, you notice here, the dollar was strong today. So again, this is kind of a U.S. story right now. The dollar was strong today, and you can see on the other end, U.S. treasuries were up. In fact, finished higher slightly. Gold also was up. It was kind of interesting that you had stocks up, but you also had, at one point in time, stocks were up, but you also had gold, the dollar, treasuries, and volatility all up too, which are typically risk safe havens or risk aversion trades. So it's kind of interesting to see how they both, but by the end of the day, they kind of pulled back to break-even levels. They didn't go down, and small caps took off. So this is a tax reform situation that we're getting right now. There's the news here of the missile launch, and you can see it impacted emerging markets. South Korea, impacted emerging markets, that Asian area more. You can see developed markets weren't impacted nearly as much. U.S. stocks came down because they've been rallying so much. There's your safe haven trades, but again, like I said, that didn't last very long. And this afternoon move higher, there's your treasuries and gold. They went down during that period. So it was full on, Bitcoin type trading that we had going on in the afternoon. Here's the sector performance today, and of course financials are loving this idea of more rate hikes, right? Eventually you would think that would lead to a yield spread, even though, again, long-term yields aren't going up very fast, but short-term yields are taking off, so they can benefit a little bit from the short-term yields. They benefit more from this yield spread being bigger, and it continues to flatten. So they got a nice little pop today. I wouldn't expect that this laggard to continue to outperform as long as yield spreads continue to fall. You can see industrials outperforming materials. Those are economic growth sensitive areas. They outperformed. They both did well early along with energy. And then you can see there's your safe haven utilities. And interestingly enough, technology, which has been a leader, did not lead today. It lagged behind in the first move higher. You can see during the pullback, real estate utilities outperformed. On the pullback, technology discretionary pulling down the most. And then you can see again, after that was, once tax reform kind of took hold, they passed that bill in the budget committee. You can see who benefited the most there. There's your industrials, there's your consumer discretionary, there's financials, consumer staples matching that move in the market. Technology, not so much. And of course, real estate and utilities, the yields falling did not help them. Yields rising did not help them. They benefit more from yields falling. So interesting move here. And again, you can kind of see, this whole buy the rumor, sell the news kind of a deal of this tax reform bill passing. We can see how the market's been pricing it in. Don't be surprised if there's kind of a, like I said, sell the news that happens. And if it's not good news, then it's, as much as it's ripped higher in the last couple of weeks, and we can see what's led the way higher in the last couple of weeks. So if I were to come over here to the 15th, from the 15th on, we've been going higher. Consumer discretionary, industrials, materials, technology, those have been your performers, and they've really done well. Financials here more just today. You can see that it was actually really lagging the market until today. So there's your winners on news of this potential reform. And if there's not good news, if there's bad news, you'll see profit or good news. If they actually pass it, there'll be profit taking. If there's not good news, then like I said, as fast as we've gone up on the idea that there could be, you know, on sentiment, on expectation, then you would expect all that just to be reversed to the downside. One consumer stock that could, you know, that you could profit from and you kind of pull back is Nike. You can see the chart here. It's approaching 52-week highs. Last time we got here in between earnings announcements, you know, we hit 60, came all the way down, and hit basically almost hit 50, the 52-week low after that. So we've gone back up very, very quickly since the middle of October. In fact, we have a cluster. We did start the day down, but like everything else, rallied and closed at the high of the day. So the question is now, if we break through 60, we could just take off. And there's a trade that we can just do separately from what we're going to talk about with that. But if it hits 60 and pulls back, doesn't have to drop back to 50, but just pulls back, is there a way we can profit from there? And there is. So let's go to the trade tab. And let's go out to, let's look at this options here. And what we want to do is a bearish trade that's not as aggressive as buying a put. So we'll do a debit call spread, a long put spread. So we'll buy a put, but we'll offset the cost and the time decay and all the expensive elements of buying a put when you're not quite sure of its downside potential with a short put, right? So we will come over here. We'll buy the 60 at the money put. About 52 days out, and then we will offset some of the cost of that with that short put there. And so now it takes away time decay, makes it cheaper. It's only $1.09 instead of $2.30. It's still bearish, but it makes it cheaper. It takes away the volatility element of it. It takes away the time element. So now I don't have time decay working against me while we're waiting for it to go down. But in case that breaks up above 60, what I'm going to do is I'm going to sell another 57.5. So it's like a naked put combined with which is a bullish trade, combined with a long put vertical, which is a bearish trade. I want it to go down to 57.5, but I don't want it to go too far below 57.5 because I have a short put there too. And that short put, you notice now because of that, I actually have a credit on this trade. And which means when you look at it on the Analyze tab here, give it a second to load up. I had it up here. There we go. Which means now, if it gets above 60, which is that resistance level, then that's my worst case scenario to the upside, that $5 credit. So it's a $5 gain is my worst case scenario to the upside. So I have a really high probability of profit on this trade because I only have a one break-even point. I don't have a second one over here because my worst case scenario is a gain. There's not a loss up here. It's a gain. So again, why? Because the debit spread will finish at maximum loss. The debit spread that was $1.09, I believe, or $1.07, will finish at a maximum loss. So I'll lose all that because I paid for it. It's a cash trade. I paid for it. I'll lose all of it. But I sold a 57.5 put, which was like $1.12. And so because it's a little bit more, and that will expire worthless, I get to keep all of it. And because of that, if it goes up and up and up, then my profits in the short put will offset the maximum loss on that long put vertical, which, like I said, is a cash trade. I lose what I paid for it. Okay, so that's that. That's the upside. To the downside, remember I have a short put at 57.5. So if it starts going below 57.5, yes, the short put vertical gets the maximum gain. So I make, you know, the $2.50 spread minus the debit. So that's my maximum gain on the short put vertical. But I've got a short put there too, which is bullish, which means I want the stock to stay above 57.5. If we start getting below 57.5, I start losing to the point where if I get to 55, I will lose as much on that short put as my maximum gain on the short put vertical, the long put vertical. You know, the one that I bought that was bearish. So, and of course, if it goes past that point. So $55, if you look at that on the chart here, let's pull it up on this chart, because I've got the break-even slice on the chart here. Finally, there's your 55. So now again, if it breaks above 60, which would be very bullish, we can look at a bullish trade, you know, because that would be very bullish. We can look at a more directional bullish trade then. But we've gone so far up so fast, it's kind of hard to bank on that breakout with a directional bullish trade now. So we're going to limit the risk to the upside to a $5 gain, worst case scenario. And if we start to pull back, great. If we pull back to 57.5, maximum gain, right? And there's the gaps here. There's going to be some support. So great. If it pulls back below that, I'll start to lose some of that maximum gain. But I've got a lot of support that will keep me with some kind of profit. So I've got a high probability of profit on this trade. That's probably even higher because of all the support that's going to be up between my break-even level and where we're currently trading at. So in summary, it was a strong day today, and obviously everybody knows how strong it was. The question is, was it too strong? And not just today, but there's been a couple stronger than expected days in the past couple of weeks. When you combine that with today, was it too much too fast that a lot of this bullishness we anticipate by the end of the year has basically just occurred in the last couple of weeks to result in a pattern that we may have seen before. So that's kind of what we're looking at today, and how does that judge, and can we make a trade in case that is the case? Is there a trade that we can make that can take advantage of that? And that's what we talked about in our trade idea of the day. So of course, thank you very much again for watching the video today and watching it day after day. I really appreciate the likes and the comments. There's been a lot of great interaction with these videos lately. So again, thank you. Have a great evening. Remember to hit that thumbs up down below the video and subscribe if you haven't already. Also remember to like the video on Twitter, retweet it, and to join the Facebook group. That being said, thanks again. Have a great one. We'll see you all tomorrow.